Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the morning, well, the Bull versus Bear morning or afternoon or evening webinar, depending where you are. But the Bull versus Bear daily webinar with Steve Miley on the call for Trade Day. So, welcome everyone. We're going to go through our usual regular setup today, a little bit different with today. We're going to go through the calendar for the week. To give us an idea of what I like to call the shape of the week. It won't take very long because it's a very light data week, actually. But we're going to take a look at the shape of the week, what we've got coming up through the week, even though we're day trading here at tradeday.com. I think it's important still to understand what's coming up, where we've got the bigger pieces of data coming up, where the bigger macro fundamental events might be coming from. So we'll take a look at the data for the week. We'll have a very brief look. This is going to be the last time until the next earnings season that I look at the earnings calendar. Because we pretty much had something like 80+% of the earnings now out of the major stocks in the US, out of the S&P 500, and the stocks we still have to come. All the big stocks have gone. The big tech stocks, the big growth stocks that can really drive the equity indices, like we saw last week with the ups and downs that we saw, with the ups with Google and Amazon and the downs with Meta. Those stocks that are going to drive markets like that are pretty much all reported now. But we'll have a very quick look at what's coming up for the whole week on the micro side, on the earnings data side. But then we won't be going back into that for another 2.5 months until the next earnings season starts. But we'll look at the macro data first. Then we'll look at some articles from the major news wires, what we've had, what we've got coming up, what's impacting markets right here, right now, and then take a look at the charts. And now we could potentially translate all of that into trading opportunities. Calendar, first of all, let's just start with today. It's light. There's nothing really of major note on that calendar today. Okay, very, very light. Nothing from the US. And if we go for this coming week, it's fairly light. We did have Chinese PMI data out overnight with the Chinese New Year all last week. That's playing catch up there. But the data calendar for today is super light. For tomorrow, you'd argue it's even lighter. We've got nothing of real note in here. Export-import trade balance data from the US. I mean, I've been doing this for 30 years. That data never moves markets, okay? So we've got that on Tuesday. Wednesday, again, it's super light on the data front. We have FOMC member Mester speaking, but crude oil inventory is coming out, but the data is all super, super quiet. It's not till we get to the to the back end of the week that things start to get interesting in here, and then we get Thursday. It's going to be the big focus. It's CPI day. Okay. Now, CPI is really front and center importance in here. Remember, all the driving forces for financial markets so far this year have been central bank activity. And that central bank activity, the more hawkish tone that we saw from the Fed, starting really in December, but really in earnest throughout January. And then into February, but then into February as well. Last week on Thursday, the Bank of England, which remember had already hiked rates last year, first major central bank to increase rates. We saw another hike from the Bank of England with the chances are for a further hike, with them voting 5-4. 5 to vote 25 to hike 25 basis points, which they did, and 4 to actually for a bigger hike of 0.5%. So very likely from the Bank of England, we're going to get another 25 in March. And then the ECB, the real shock, and there's a few articles out here on that last week, were joined the party, really, the hawkish party of indicating potential rate hikes. And we've had the guy's name is, I think it's not, anyway, an ECB member, he's a hawk, indicating a potential hike as soon as the end of this year, and then another hike next year as well. So certainly looking for the ECB to start indicating that after their meeting last Thursday. And we've seen a rush to, having already seen a significant move to lower bond prices, higher bond yields throughout January into February and last week, from Thursday through Friday and even into this morning, we're seeing a significant sell-off in European bond markets, European bond futures, notably lower in here again today. The bond market, the Bund future market, the gilt future market, and the cash markets have all sold off again in here today, and that is on the back of that more hawkish tone from both the BOE and the ECB. So driving bond markets lower in price, higher in yields. So we have three of the world's major central banks in here, all signaling a far more hawkish tone into this year. So that's been a big driver. And why are they doing that? This is the reason I'm talking about all of this. Why are they doing that? It's worries about inflation. We're in a post-pandemic recovery. Financial markets have stayed strong. The equity markets have stayed strong in the recovery. Since the big financial market sell off, the equity market sell off that we saw back in 2020 as the pandemic broke. But then, equity markets have stayed strong, and the economies globally now are in a strong position. And the worry is CPI data is at multi-decade highs globally, record numbers in the Eurozone. Remember, the Eurozone as such has only been a place since, with the Euro since the turn of the century. So, but multi-decade highs in inflation numbers in here, real concerns. So CPI is front and center important. So we'll certainly be watching that. So that's the real. I mean, we've got nothing major, nothing really hardy at all at the US before then. Nothing. You've got crude oil inventories. You've got weekly data in here. But nothing really significant until the CPI on Thursday. And then on Friday, we get UK GDP manufacturing production data. And then we also get German CPI as well. And then some Michigan consumer data, consumer sentiment data we get from the US on Friday. So a light into the week. So really, we've only got the only real data to focus on for the whole week is Thursday's CPI data with respect to US data. And then that UK and German data that we have on Friday. Before that, the data calendar is very light. A quick nod to the earnings calendar, and it will be a quick nod in here. So you can see nothing really big in here. Amgen today. We have Pfizer. So the ones to probably watch out for if you're going to watch any going into this week, we have Pfizer on Tuesday, Disney on Wednesday, Coca-Cola, Pepsi, and Philip Morris all on Thursday. And that's going to be pretty much it. Really is going to round off earnings season. But I don't think those stocks are going to, if you're trading the indices, I don't think they're going to really impact onto the indices. Disney sometimes can, so maybe watching out for Disney. Just a little rewind on the data. We did have the NFP, the employment report, which was very strong compared to consensus, rose at 467,000, right at the top end of consensus in here. Remember, we had a range of negative to positive in here. So 467,000 in January. And a spread across all industries, much better than anticipated. And the markets actually reacted fairly well. The bond market sold off aggressively to higher yields, as this is going to just open the door, strong recovery. There were concerns that Omicron in here the surge in Omicron was going to cause problems for the labour market, but that didn't happen. So that just puts the Fed even more in play, given that the labour market continues to stay very, very, very strong in here. But equity markets didn't sell off on that really particularly. They held in fairly well last week. The other thing to say, which wasn't on our calendar, is that Lagarde, ECB President Lagarde, is due to speak later today. It's at 3:45 p.m. GMT UK time. Okay, so watching out for that, guys. Okay, remember they shifted, the ECB shifted to a more hawkish stance certainly on Thursday. So let's have a see in here. We're getting, are we going to get any clarity? Is she going to be concerned about the way the market reacted to the statements and the press conference? And maybe there's a backtrack, maybe not, maybe there's confirmation. But that's going to be something to certainly watch going into today. Let's have a little run through what Bloomberg have got on their 5 things to start your day. Well, bonds, talking about the bond market sell-off. Bonds lower again in here today. Australian bonds dropped lower. The yield on the Japanese 10-year its highest level since 2016. So this is not just the US anymore. This is global, okay? And it's not just the from the ECB and from the BOE, the Bank of England. It's not just Europe and UK. This is a global move to higher bond yields, lower bond prices on the back of concerns around inflation and global bonds pushing to higher yields. A slight positive in here, the president of France, Emmanuel Macron, goes to talks with Putin today in Moscow, and also going to Ukraine, I understand, as well. So certainly positives in there. Looks like maybe a conflict is going to be avoided. So that's going to be that's certainly seen as a positive. Crypto, Bitcoin rally, and going into today, markets mixed. Okay, and then just a couple of other articles, just kind of reflecting the same sort of stuff we've been talking about in here. It's a new cycle. Wake up and smell the coffee, right? So this again is talking about European Central Bank. It's talking about the higher bond yields, and it's talking about a new move in the cycle. Okay, so that's that. And then again in here, Reuters, another article. Again, European bond yields soar on tightening talk. US stock futures dip. So we had a slight dip. Moving into the day, so we can have a quick look at the stock indices. So European stock indices mixed in here. French CAC pretty much unchanged, slightly up on the DAX. FTSE's slightly higher. FTSE's doing fairly well today, but mostly fairly mixed in here, like around unchanged. If we go and look at the futures, and we can go look at the chart shortly, but in here on the futures, we're kind of unchanged from Friday. So the S&P is just slightly up, and the Nasdaq pretty much flat so far going into today. And then again in here, something we've already looked at, though, Wall Street week ahead, inflation data. So that's the next focus. We've already spoken about that after the move higher in bond yields. Let's take a look at some charts. Yeah. So we did get a setback at the end of last week. So we had a really strong rally. It was erratic. This is the S&P 500 on the daily chart. It was erratic, but we were higher. We turned lower into the end of the week. We did on Thursday of the dip and the rebound, and again lower on Friday on the back of the employment report, which is strong. Which again, I did say this in the call on Friday. Strong number's not going to be good at the moment for the stocks in here, because strong number points the Fed to be more hawkish, which stocks are not liking. So markets sold off on the strong. Back earlier in the cycle, 6 months ago, that strong data would have seen equities up. Now it's meaning the Fed are more in play, even more potentially hawkish. So stocks were down, but they did rebound in today. And you can see, look, dip and a rebound again in here today. Okay, so we're getting, if you look on Thursday, dip and a rebound. Friday, dip and a rebound. Today already, dip and a rebound. The market's kind of rejecting the downside and building on this strong rally that we had through the very end of January and the very beginning of February. This strong impulsive rally. And that was despite that bad metadata, remember, as well. Okay, the metadata was impacted in here as well. That was the sell-off on Thursday here. The sell-off on Thursday was Meta. And then we had the really strong numbers out of Amazon, which took us all the way back higher again. So for me, this still sets up positive when we zoom in on the 30-minute chart on the S&P in here. So there we go. There's the recovery rally. There's the setback. We have dipped back, and this is the impulsive move that we saw to kick off the week in here a week or so ago. A really impulsive move back higher. But if you look here, the market's going to dip down into this area. It's kind of gap in here and then rebounded out of it. And although we've got lower lows and lower highs, a little bit disappointing in here. Okay, we do have lower lows and lower highs over the last few sessions. The market seems to be trying to turn now. We've got two sets of lower highs, higher lows, in here. Okay, and if we look at this little counter trend line, I'm going to get rid of. Remember, on the bigger chart, we've reversed the bigger trend lines. But if we go to, I'm going to get rid of a lot of these old. Whoops. 1 second. I'm going to get rid of all these old lines in here. And then what I'm going to focus on in here is this off the top. What do we need to do to break the counter trend? This is a counter trend line. It's counter to the main trend. The main trend being a line that is up. Okay. And look, we're getting close. And then you say lower lows and lower highs. Lower lows, lower highs. We had that spike higher. Okay, back here on Friday. Okay, and then the sell-off that was around the data, and then the market in here is now put a higher low, two higher lows. They're around the, well, I can tell you exactly where they are in here. So we are 44.71 and 3/4, 44.72.5. Yeah, so 44.72.71. Whilst we're above 44.70, this looks bullish to me. And I think if we reverse that counter trend line that comes off these two peaks, then the risk is significantly higher, potentially even today back up to the recovery high up here towards 45.90. Okay, so and triggering through that trend line. That trend line currently coming in around 45, 12, 13 kind of area. So looking for a breakthrough there. And again, with no data, it's going to be all on the waiting for probably the cash market to open. Okay, similar tale with the Nasdaq. Let's take a look at the Nasdaq again. Look, these sell-offs in here from the data, from the earnings data we have. Meta sending us lower, Google, Amazon sending us back higher, and then but then look, Thursday dip rebound, Friday dip rebound. Okay, this morning dip rebound, and again we step in. And it's all part of this basing process that we saw at the end of January, the strong rally that we saw early last week and the end of January. And if we then step into a 30-minute chart, again, I'm going to get rid of these old lines we've got in here, and we'll be looking at in here this counter trend line again off the top. Yeah, and really goes through there, right? We've already broken that counter trend line. That's realistically where the line is. And then even if you draw it out further to this one here, look, you're playing with it now. So you could argue that you've already got the base in. You could argue down here, okay, on this. So if you think of this as a mini downtrend, you could argue down here we have an inverse head and shoulders. So here's a shoulder, here's a head, and this is the other shoulder. And then you just simply draw the line across here. It's pretty much horizontal. If we get above these peaks in here, which are 14,819 and a half, 14,825 and 3/4. If you can hit, and then you got another little peak over here, 14,842. If you break above 14,830, this looks like inverse head and shoulders, and then that would aim us back up to the highs. Yeah. So that's going to be an important, just getting above these peaks. But it looks like we reverse this trend line, first of all. Then you put in the higher low. You put in another higher low. Okay, this peak, even above this little overnight peak in here, that's at 14,744. If you want an early entry up through there, 14,744, or a later entry up above these peaks up here, So yeah, this is looking even firmer to me. And then obviously on the bigger picture, if we zoom further out, you've got this much stronger basing pattern down here. And you can see as we move back here, down here, at the top of this basing pattern here is kind of where we've held. So you've got this kind of big inflection area all around here. Yeah. If I can get a let's see if I can get a shape and get a rectangle. So it's kind of like in here, right? You've got this area here. It becomes pivotal, inflection area. Yeah. So look, previous peaks and failures all in this box. And then lows in here in this box as well. So this is kind of this whole 350, and that's a wide zone, guys, for a day trading. But this 350 to 550, 14,550 to 350 area is a really kind of important inflection area. And whilst above here, I think you have to play it from the long side, particularly with these trend lines being broke. And so you've got inverse head and shoulders. So that's all looking quite bullish to me. Let's have a quick nod to the commodity markets. First of all, we'll go to gold. Again, here, this is the daily chart on gold. I've got no strong view. Let me pop this out bigger for you. And this is just chop fest. I would not be trading this. I would not be trading it. I really don't have a strong view. And then if you go to oil, same old, another new all-time high, not all-time high, excuse me, another new multi-year high in here. This has got 100 written all over it going forward. A dip, another buying opportunity. And if we step in and we take a look at the intraday chart, there's the dip. You've already had the buying opportunity today. Probably if you go above again, you've got this little counter trend line. This is on the 1 hour. Let me take us out to the 30 minutes or into the 30 minutes. We'll do the counter trend line off the top. And then you could argue then the more accelerated one we're already breaking through, or close to, if we're not already through already. No, we're not through already. So that more accelerated one, that more accelerated one is going to come in around 91.80. So above 91.80 will be a signal, or the higher trend line here, 92.20. So 91.80, 92.20. If you're going to wait for the higher one, you might as well wait for that peak there, which is 92.31. So 91.80 or 92.20, 30 area will be triggers in for a long. And then there's no reason this can't go to another new multi-year high. So staying bullish there. All right, guys, I'm going to wrap it up there. I'm going to wish you all as ever a great trading day. Stay safe. I'll be back with you with another bull versus bear webinar on Tuesday.